Hey guys, Werner with the Red to Black podcast, hosted by Werner, and that way is Mario. And today we are discussing the insanity of the euphoria, of the excitement of these markets. You do not want to miss this one today because the bubbles, the records that are being broken are like nothing we've ever seen. And I want to start out with a little paragraph from a book called The Age of Stagnation by Satyajit Das. I probably butchered that name. So if you're listening to this, you're probably not. But if you do, a few years from now, just send me a message and let us know. So this book is all about how we transition from a productive economy, and he wrote this in 2016, to a debt-based economy. And this is what we're seeing play out today. So he says a confluence of influences is behind the ignominious end of, that's a hard word, of an era of unprecedented economic expansion. Since the early 1980s, economic activity and growth have been increasingly driven by financialization, the replacement of industrial activity with financial trading, and increased levels of borrowing to finance consumption and investment. By 2007, $5 of new debt was necessary to create an additional US $1 of American economic activity, a five-fold increase from the 1950s. So as we talked about on podcasts, as you get more debt load, you can become less productive. Right? So debt levels had risen beyond the repayment capacity of borrowers. That's a key statement, triggering the 2008 global financial crisis, GFC, and the Great Recession that fall. But the world shows little sign of shaking off its addiction to borrowing. And I know this because I'm in the real estate world, so it's near and dear to my heart. Ever increasing amounts of debt now act as a brake on growth. Mario, take it away.
So financial engineering always ends bad. It's a house of cards that's going to collapse. I don't want it to. I'm not excited about the financial engineering that's happening, collapsing. It's going to produce opportunities, but I mean, there's suicides, there's destructions of marriages, it hurts your economy, it hurts the country, it hurts your culture. So not in favor of this at all. I'd rather have rational markets. I want to read something real quick to you, Warner. This came out in Zero Hedge this afternoon. It says investors have poured almost $900 billion into equity funds in 2021. $900 billion. Exceeding the combined total from the past 19 years. What we see actually is companies are going out to banks and raising cheap debt and buying back their shares. So we have the creation of money. We know that the commercial banks can create money. They're giving it to the corporations at very low interest rates, and the corporations are going out and buying their buying back shares, and that's what's propping up the market. That's the biggest driver pushing the market higher and higher is cheap debt issued by commercial banks, taking on that debt with corporations who are buying back their own shares. They're not doing it. Most of the companies, 99% of the companies are not doing it with free cash flow, and that's the financial engineering that's going to bring the whole house of cards down.
Yeah, and one thing that not just one thing, Mario and I mean, we could literally be talking to you our listeners for the next 5 days about all the records that are being broken. But to give you two examples, I was listening to George Gammon. If you haven't checked him out on YouTube, great guy. He's all for financial freedom. Mario and I watch him. He's just
big fan of George. Think he's a good guy.
Yep,
one of the good guys.
Straightforward. He's trying to figure out like the rest of us. None of us have got this figured out 100%. So he said I think he was in Texas. Maybe I may stand correct on that, at an event. And the guy comes up to him and says, yeah, I have about, I don't know, 20, 25 grand total. And I turned that 25 grand in the Bitcoin type markets or the blockchain coin markets. And I turned that into 4 million over last year. And my jaw just dropped out. I'm like, that is not normal. You don't turn 14,000, whatever that X return is, way over 100. That is not a normal market. That's insanity. And then he went into talking about, because he was interviewing this other trader who's like a successful trader for 40 years, which is rare, guys. So if you find one of those guys, listen to them if you're into that business, which we don't recommend doing. But what he said to him is like, and they were talking about the psychology behind it, because this trader had been there, had really just started his career really in 2000. So he watched that like go up and down. And what he said was, he said a really interesting statement. He said, you know, you're going to a crash when you have bad advice or bad market news and the market goes up. But when you start getting good news and the market goes down, he's like, that's when it starts. When you get good news and it's going down. The reason that's the case is it has to do with trust in the system. And when you lose that trust, it doesn't matter whether news is good or bad. It just happened to be the news. The example was the news was good, but the trust. So you always want to look at the trust in the markets. That's the key. And right now, we have a lot of euphoria, and there's a lot of very successful investors, Michael Burry, Ray Dalio, all these guys are warning in different. I mean, literally, I've never seen so many guys coming out and just warning. Like every investor you can think about is a warning in some way, shape, or fashion. Another example of this insanity is Tesla and Ford Motor Company. Tesla's trading at $1,000 a share, and I think they make somewhere around $40 billion in revenue a year. Ford makes somewhere around $130 billion, so almost more than 3 times in Tesla. Yet Ford is trading at $19 a share. Now, to be fair to Tesla, Tesla's now at a 16% operating margin. Good for Tesla. They weren't making money. Now, we want to dive into those numbers to see if that's.
Well, what's the, yeah, I mean, that's, I gotta stop you there, Warner. It doesn't matter what the share price is, how many shares are outstanding. So what's the market cap of Tesla and the market cap of Ford compared to 40 billion a year revenue for Tesla and 130 billion a year for Ford?
I wish you hadn't asked me that, because I was actually doing those calculations and I was like, I'm not going to do them. We're just going to talk about this one. But I was beginning to do those calculations. So, you know what, guys, for this one, we're going to shelve that one, because that's a good point, because it's relative to the shares outstanding in our case, we want to divide the operating margin by the shares outstanding to get a price per share. That's where Mario's going with that. So I'll get back to you on that one in tomorrow. Let's say tomorrow's video, or when we come up next time, I'll get back to you on that one. So I don't have the answer to that. But anyways, that market, I still think Tesla, I've done the numbers on it before, and Tesla is still like the multiples are insane. I've done it before. The multiples like way over 100. So I don't have the exact numbers, but I do know the multiples on Tesla are not like in the ballpark buying range. And how do you know that? Because Elon Musk said a long time ago that around 150 a share, 150 per share was like too much to pay for it, and now he's selling it $1,000. The guy who owns the company is selling, guys. What does that tell you?
Now, we talked about Jeff Bezos selling. We're talking about Elon Musk, and now we have Satya Nadella, who's the current CEO of Microsoft, selling half of the position of Microsoft. They're not doing that. They're not doing that because they think it's undervalued or not properly valued. They're saying this is a unique opportunity to stack a bunch of cash, and then they'll buy back in later. Maybe not even invest in that same business. They'll go into something different. But this is a great selling opportunity. And people are trying to say don't sell, don't stack cash. There's hyperinflation, cash is trash. The reality is, go look. Don't take that as gospel. Go look at the dollar versus the Canadian dollar. You get $1.21 in Canadian dollars for every dollar. The U.S. dollar has not crashed in relation to other currencies. There's no U.S. dollar crash happening right now. It's very strong. In fact, it's one of the strongest periods in history.
Yeah. So I could go off on a tangent on gold on that one, but we're gonna keep it focused on the euphoria and the excitement. So looking at companies like Tesla, looking at companies that haven't made a margin are inflated. Like, to give you an example, we were talking about fintech. We were also talking about, either I was talking with you or it was in one of the Red to Black Academy. I was talking about how IPOs 20% are profitable, 80% are not. And the last time that happened was 2000. So what we're seeing is, now here's the thing, not all of the 2000 metrics have been met. 2000, people don't realize this, but if you look at some of the metrics, some of the inflation metrics, 2000, there's a few, I forget what they are, economic metrics have not been met yet, but we're close on all of them. 2000 was a massively inflated tech bubble that blew up big time, but it was it was relegated to that tech bubble. The difference nowadays is you have a tech bubble. You have a Bitcoin. I consider Bitcoin blockchain on its own. Bitcoin bubble. You have a housing market bubble. You have what other bubbles do you know of, Mario?
That's the everything bubble. I can't think of anything that's not really overvalued or properly valued right now. There's very few opportunities to go in and buy an asset or something that pays you to own it that's cheap. I don't see it ever. Maybe in certain types of real estate, I would think maybe in the office space or retail space, you might be able to find some cap rates that are 7, 8, 10, 15%. If you go into certain markets like and buy stuff that's mostly vacant right now, 30% vacancy, 50% vacancy, 80% vacancy. I looked at a commercial real estate property recently outside of Charleston, South Carolina in Mount Pleasant. And it was the only thing I could find, just going after what's cheap, what's out there that provides you a good return on your investment. And it was an office building and the current occupancy was 30%. And it was trading at a 15, but you're getting a 15 cap, so if you can raise your occupancy rates, it's not even raise rents. It's just, can you get people attracted to going back to an office space? But 30% occupancy in a building, it means it didn't need to be built. That real estate is not properly positioned in that market to fulfill demand. So I would say almost everything's overvalued. Go ahead, Warner.
And just a note, if you're thinking about going to real estate, I did an interview with my friend Chris Montes, who's a mortgage banker, which means he issues loans, he looks for loans. That's what he does. He's a financing guy. And basically we came to this conclusion in real estate, anytime if you want to get started in real estate, so let's say it popped into your mind when Mario mentioned that, it popped into my mind, hey, can we go turn around that building? Well, the first thing popped in my mind is, I don't know. I don't know the local market. So if you're ever thinking about going to in real estate, the key to real estate that most people forget is don't buy something sight unseen when you're in another state. You want to be in that local market because maybe that 15 cap is a great deal. Maybe because there's a lot of things we don't see. Maybe the guy who managed it doesn't see an opportunity, or maybe it's a crappy opportunity like Mario said, and there's no demand for it. But you would never know that. You would never know that if we didn't go over our checklist, guys, before we started to silence the cell phones. So basically, let me just silence this real quick. I apologize, guys. So basically, you want to be local in a market like real estate. And what this points to is what we're talking about, whether it's real estate, local market, or it's any asset you're dealing with. In an inflated market, you want to know the underlying fundamentals of that asset. If the underlying fundamentals of that asset don't make sense, then don't do it. But what people are trying to do right now is they have this notion in their head that they just want to make money. But they don't realize how you make money. They just think making money is throwing it at something that's appreciating. That is an absolute fool's game. And because we have so much debt in money and euphoria, we are seeing this curve that people talk about at the end of a cycle. It just goes like this. As Mario said, that number, 900 billion, 19 years. I mean, come on, guys.
Yeah, exactly. The total amount of money that's flooded into equities is 19 billion in 1 year, which is more than 19 years prior. That's coming from the commercial banks. The commercial banks are issuing debt to corporations. This is not retail. This is not mom and pop money that's flooding the markets. This is cheap debt.
You think it's
absolutely,
cheap debt?
Absolutely. You can't get 900. It's cheap debt from banks being issued to corporations who are doing share buybacks. And when that dries up, when those companies are losing money and they can't make they're struggling to make their debt obligations. Very first thing that goes is stock repurchases. The market crashes. This thing goes down and tanks. So I'm gonna first entertain buying wonderful businesses, and then I'm gonna go second is look at the real estate market, specifically college towns that have maybe too much inventory that are getting just hammered, where you can pick up some good quality buildings at reasonable prices, and try to convert them in maybe to luxury apartments, or try to go after a different demographic than college students. Maybe they're by a downtown nightclub / bar district, and you can convert them more into luxury apartments than college housing.
Great points. And what we're pointing to here is if you listen to a lot of YouTube channels, and I'm not knocking them, I would say most channels, they give you the information, what's going on in the current environment, but they don't give you the skill sets like Mario and I are giving you to actually execute on how you actually make money. They say, well, oh, the market's inflated, just wait and buy low. What are you buying?
Right.
How are you buying? See what Mario and I are giving, it comes from our military backgrounds. I'm a pilot, he's an infantry officer. We take a tactical approach. It's built into the Marine mindset, which is like analyze, don't just take it for granted. Go out, and you're not going to know everything, but you can know the basic core fundamentals of which there's a certain way to fly an aircraft. There's a certain way to employ a tactical plan. And basically, if you do that over and over again, you'll be successful. Will you meet roadblocks? Yes. But if you're just going to like listen to individuals on YouTube and say, oh, the market's crappy, follow my channel or sign up for my Patreon where I'm going to give you like announcements on when to buy stocks. There's nothing wrong with that. But if you know what you're doing, if that guy is helping you to look for stocks that you're looking for at certain prices, then that can help. But if you have no idea what you're doing, why are you just going to take advice from someone else who's giving you a buy alert? It makes no sense. You want to know what Mario's talking about is what he says, the key word, the key to making wealth and avoiding financial destruction is knowing how to buy wonderful businesses. What's a wonderful business? It's a highly profitable business, cash flow margin, meaning the cash in the account from operations divided by the revenue. Go to the cash flow statement, right? Go to the income statement. Stick around these videos, learn more about that if you don't. But those are key metrics to know. If you don't know about those things, go research them right now. Income statement, revenue, cash flow statement, and then divide the cash flow statement from operations by the revenue, and you'll get the percentage of the cash that's left over in the business. That is a key statement. And most people don't do that. They're just like, oh, I'm going to get the stock alert. I'm going to go into Bitcoin because no. Go to the basics of what makes a business, the performance of the business, which is cash flow.
And our goal here is really to build a community. We're going to find like-minded people by pushing out this energy into the universe. We're going to find like-minded people. A lot of people are going to just disregard the slow and steady approach. What's popular right now is the easy, quick, fast approach. That's what's popular right now. But the steady Eddie, slow tortoise approach, which is going to guarantee you to get there, it's just going to take a while. It's not popular. So we're not going to convince a whole lot of people our way is right. But those that recognize this, we'll develop a community, and we'll be sharing our best ideas, and we'll be linking up with you guys and learning more about you guys as we grow this channel and as we grow our businesses together.
And I want to give you an example of what Mario's talking about, because I was thinking about this today in the last days. That is, you want to be a pro athlete, you want to be an F1 driver, you want to be like LeBron James. And I know he's got more talent than any of us, Mario and 20 other white dudes put together playing basketball, right? So, but my point is this: LeBron James, even great quarterbacks like Tom Brady, he wasn't the first pick. If you look at a lot of these great quarterbacks, did he become a great NFL quarterback in a year? No effing way. Did Lewis Hamilton, who came from no money, become a great F1 driver in 1 year? No way. It took him 10 minimum years. But yet what we do when we look at everything else, whether it's athleticism or getting your PhD, whatever it is we all know it's like it takes 10, 20 years to get there. But but for some reason, I've talked about this before, when it comes to making money, it's like we just throw everything out the window. Oh, no. It's gotta come quick. Making money, creating wealth is no different than anything else. But the ramifications are way heavier than you not making it to the end. I got it. You're not going to make money. But the ramifications are way heavier because you could put your whole livelihood on the line and tank it like that.
And that's why it's so destructive. It blows up marriages. It makes people commit suicide. It destroys communities. These leverage positions in speculation, betting on direction of a price of a coin that doesn't even exist. It's not even a coin. There's no coin. It's a ledger entry. You're betting on that direction and you're leveraging that. It blows up marriages. It blows up people's lives. It creates suicide. It's disgusting. But there's no convincing, most people that easy money isn't the path. Again, inch by inch is not sexy and it's not easy. But it's the right move. And time, like this thing, you judge these guys by their 30-year record, not their 3-minute record.
To end on that point, phenomenal point, guys. If you're not a subscriber, subscribe. If this content provides value for you, our request is that you send it out to at least one friend or family member or more. And then like and comment to tell YouTube to send this message out to the world. Guys, we're a small channel. We can use your support. So help us boost this out. And then finally, it's a pleasure being with you, and we look forward to connecting with you in the future.